Welcome to The Explainer. Today, we're cracking open a document that tells a fascinating story. It's a story of sky-high corporate ambition crashing right into financial reality. We're going to unpack the 2026 Form 40F filing for Aurora Cannabis. Now, on the surface, corporate filings can look incredibly dry. But I promise you, if you know where to look, they reveal exactly what's actually happening behind the scenes. Just look at the sheer scale implied by that giant, bold blue logo on the cover of their consolidated financial statements. It sets the stage for what looks like a totally standard, highly optimistic corporate disclosure. You've got this massive company projecting strength and stability to its investors. But as we dig into the actual pages behind this logo, a very different picture is going to start to emerge.
Okay, let's dive into this. Here is our roadmap to make sense of this dense SEC filing. First, we'll look inside the Form 40F. Then, the forward-looking vision, who makes the rules, the auditor's reality check, and finally, the material weakness.
Section 1. Inside Form 40F. Setting the foundation.
All right, so here is the official front page. The Form 40F is basically the annual report filed with the SEC by certain Canadian companies. This represents the ultimate legally binding financial record of Aurora Cannabis's fiscal year ending March 31, 2026. This isn't a PR brochure, right? It is the called hard disclosure of exactly where the company stands.
Moving on to Section 2. The forward-looking vision. Corporate ambition.
When you read the management's discussion in this filing, wow, the ambition is just palpable. They lay out some truly massive, optimistic goals here. We're talking expansion into new international markets, achieving sustained profitability, and positive free cash flow, which, let's be real, is the absolute holy grail in the cannabis industry right now. Plus, they highlight the strategic acquisition of the Safari Flower Company and a major pivot to wind down their consumer business so they can focus their strengths elsewhere. Sounds pretty fantastic, doesn't it?
But hold on a second, we've got to drop the energy and read the fine print. Look at this crucial disclaimer language right from the filing. Forward-looking information and statements are not a guarantee of future performance. This is how a company covers itself legally. They're explicitly telling investors, hey, these are our absolute best guesses, but reality might have a totally different plan.
And you can see that tension laid out brilliantly right here. Across these pages, Aurora lists this massive catalog of risks that could completely derail all those big plans. They list variables ranging from the yield of their cannabis growing operations and commodity pricing, all the way up to global epidemics and pandemics. It really shows you just how fragile those optimistic forecasts are when they hit the absolute unpredictability of the real world.
Which brings us to Section 3. Who makes the rules? Governing the report.
So, before we talk about the financial watchdogs, let's clear up a bit of legal jargon. Aurora Cannabis is classified as a foreign private issuer. What does that actually mean? Well, even though they trade on the US NASDAQ under the ticker ACB, they operate under slightly different rules because they're a Canadian entity. They use something called the MJDS, the Multi-Jurisdictional Disclosure System. It's a mouthful, but it just means they can prep this report mostly using Canadian disclosure rules instead of strict US GAAP accounting principles. But regardless of the jurisdiction, you've got to have governance. The filing details that they rely on an independent audit committee to oversee all this complex reporting. The board has designated members like Chitwant Kohli, the chair, and Michael Singer as audit committee financial experts. These folks are basically the internal line of defense, responsible for pre-approving all the work done by the outside auditors. And speaking of those external auditors, take a look at these staggering numbers. For the fiscal year ending March 31, 2026, Aurora paid the accounting firm Ernst & Young over 4.7 million Canadian dollars just for audit fees. 4.7 million. That is a massive chunk of change dedicated purely to verifying the math and the accounting processes behind the company's grand vision. So, for almost $5 million, what did the auditors actually find? Let's find out in Section 4, the auditor's reality check, the inspector's view. All right, here is the formal report of the independent registered public accounting firm Ernst & Young. To really get what this document is saying, think of the inspector analogy. When you buy a house, an inspector checks two main things. The house itself, does it look okay right now? And the foundation, is the structure built on solid ground? E&Y was basically hired to inspect Aurora's financial house and its financial foundation. Now, what's really interesting about this slide is the stark contrast in E&Y's findings. On one hand, they issued an unqualified opinion on the financial statements themselves. In plain English, they're saying the house is currently standing and looks fair. But on the foundation, the company's internal controls over financial reporting, they issued an adverse opinion. They explicitly stated that the internal controls are not effective. So the house is standing, but there's a huge crack in the foundation.
To understand why that foundation is shaky, we have to look at what E&Y called critical audit matters. These are the parts of the business that are incredibly tough to measure. For example, Aurora has $23.8 million tied up in European cannabis intangible assets and another $20.2 million recorded as cannabis biological assets, which literally just means living cannabis plants. Trying to value living plants before they're even harvested requires some highly subjective assumptions. You're predicting average selling prices, forecasting yields per plant, estimating completion costs. These are basically forward-looking guesses baked right into the balance sheet.
And that leads us to Section 5, the material weakness, a flawed foundation.
So the crucial point is this specific term right here, material weakness. Now, this isn't just some minor accounting typo. In the world of SEC filings, a material weakness is a massive, heavy red flag. Ernst & Young identified a material weakness specifically when it comes to the completeness and accuracy of the inputs used for these significant estimates, assumptions, and formulas. Just listen to the exact gravity of the auditor's own words here. There is a reasonable possibility that a material misstatement of the company's annual or interim financial statements will not be prevented or detected on a timely basis. Let that sink in for a second. The auditors are flat out warning investors that the company's internal systems are deficient enough that a massive financial error could slip through entirely unnoticed.
And you know, this isn't just some auditor's opinion that management can just brush off. Because of the Sarbanes-Oxley Act, leadership has to own this. Take a look at this official certification signed by CEO Miguel Martin. Both he and CFO Simona King legally had to sign these documents evaluating the effectiveness of their controls and explicitly disclosing these material weaknesses to the public. They literally had to sign their names acknowledging that their financial foundation has a crack in it. Which brings us to the critical takeaway from this explainer. We started out looking at these grand visions of global expansion and sustained profitability, but we end up with a formal admission that the systems tracking the math behind that vision are fundamentally flawed. So it begs a really fascinating and kind of uncomfortable question. If a multi-million-dollar company can't guarantee the accuracy of its own subjective financial inputs, what else might be hiding in the weeds? Thanks for joining me for this explainer, and remember to always keep questioning the numbers behind the narrative.